So welcome to another edition of Stellar Conversations. I'm Craig Simmers, CEO and founder of Stellar Strategic Group. And today we've got Brian Jones, CEO of Gravity Lending, who obviously in the auto lending space needs no introduction, but welcome, Brian.
Thank you. Thanks for having me, Craig.
So Brian, as you and I were talking a little bit earlier, the pandemic is got to be part of practically every conversation we have these days. So I'll share a little bit after you do, but tell us the last 16 months, how much effect has it had on your business, if any?
I think it's had a profound impact on us, but not necessarily in a negative way, mostly positive. So we're a fairly young company, a couple of years old, and we happened to get started right before the pandemic really fired up, which created an interesting dilemma. Thankfully that I had reconvened with a lot of ex-colleagues that were very experienced and knowledgeable, so most of us going remote was relatively painless. But then something extraordinary happened and we started to grow very quick. Lenders started coming on board at a rapid pace, and we grew so fast that if I hadn't been able to push everybody remote, we would have had to actually slow down our growth because of our limited space, which also helped us save money on office space as we grew and tripled, quadrupled the company in a matter of 12 to 18 months. So the pandemic was actually a godsend for us. All the deposits that were drawn to the lending institutions also opened a door for us, and they needed additional assistance in lending that capital. So everything really came together, and we're probably one of the few sectors that really benefited from the pandemic as opposed to others.
Yeah, on the auto side, we had the same effect. And I remember you telling me, if we hire one more person, I'm going to have to work out of my car. And we remember that conversation?
I do.
And in our case, we offer two products. And from the beginning, 20 years ago, our core product was checking account acquisition. Everybody's flush with deposits. The last thing they need right now is checking accounts and low-cost deposits. So we didn't expect the growth on the auto side to happen so quick. But just like like you were talking about, it just blew up on us. And as good as the auto side is, that's how much the checking side slowed. So, I look at it as, thank God that we had the auto business. It had already ramped up. We were ready to expand. We just didn't know that it was going to happen so quickly. And so I don't see a slowing yet. I mean, if anything, we're starting to attract much larger credit unions into the program. And the amazing thing is the phone's starting to ring on this end,
right.
which is always a good thing, because typically you're out there just, pounding the pavement, making the contacts. But, the phone's actually ringing. And I think we've done a pretty good job of accelerating our marketing and building capacity. We've got plenty of capacity. And one of the things I wanted to ask you, if there's any issue that we're dealing with right now that's on the negative side, is we just can't hire people, because we have both an inbound and outbound call center. So we're talking about combination full and part-time employees. We're having a heck of a time. Full-time, we're able to find people. But, we're in a market here in Annapolis where there's a lot of service and a lot of restaurants, bars. So you would think we'd have an easy time finding part-time people. But obviously with the unemployment benefits that are being paid, we're having a heck of a time. We've got 4 or 5 positions open now that fortunately we don't need until midsummer. But we had planned on filling those positions now to have them in place. And so, from a negative standpoint, that's the biggest hurdle we're dealing with right now. But hopefully that'll, some of the states are starting to take away benefits. Benefits are starting to expire. I don't know if you're seeing the same thing down there.
We are. Austin's unemployment rate was extremely low pre-pandemic and relatively low throughout. So finding talent was always difficult. You get lots of resumes in, but they really pan out. We've really built this company around referrals from internal employees. And we worked very hard on the culture of people wanting to be here, flexible schedules, work from home, things of that nature. And we actually pay some incentives to our employees if somebody they bring over stays a certain amount of time. Yeah. And so remove some of that unknown quantity from hiring somebody you've never met by having that connection. And you also get your employees a little more committed because they have to live up to the person that referred them over to us.
Absolutely.
So we are experiencing some of that, but it hasn't really slowed us. And with our business, it's a juggling act between lending institutions, leads, and staff. And when you can get all three of those things working together, everything's perfect. And so we've done a fairly good job of balancing it. But we did find ourselves a couple months ago where our growth slowed because we didn't have enough staff. So we ramped up rather quickly, brought in a bunch of referrals, and the company took off again and doubled month over month earlier this year.
Yeah. Yeah. I think it'll play itself out. And again, those positions that we were recruiting for over the last few months were really geared towards midsummer. Right. And because of the influx of new clients, but it's been a struggle. Hopefully it'll free up. But from a production standpoint, we've got more than enough capacity. I had what's going to be a new client this morning on the phone, and he throws out at me, he says, I need 10 million a month in auto loans. And he said, how quick can I get 10 million a month? And I'm thinking to myself, I've got to be honest with this guy, because, you just don't turn a switch on, as it takes several months to build up to a number. And I'm thinking while we're talking, I'm thinking to myself, well, this hiring problem that we're having, we better fix this pretty quickly, because add that on top of the other new clients coming in. Our call center, our outbound call center, is going to double in size over the next 60 to 90 days. So we better figure out the hiring issues that we've run into over the last few months. And I think it'll start to soften out a little bit. At least I hope so.
I think it will. You mentioned about the guy calling and how much can I get? Can I get 10 million a month, and how fast can I get it?
Yeah.
Favorite stories about those are when they've had your agreement for 3 months and they finally get it back to you after 90 days, and the call the next day is, hey, can we get up this week? What's going to take you so long? And it's like, well, okay, let's go through the process. But I think a lot of the lending institutions have that sense of urgency now, and they've been caught off guard due to the rapidly decreasing new purchase market, lack of chips, lack of inventory. And so they've been caught early in this year understanding they're never going to get to their quotas or their budgets. And so now they're panicking a little bit, when if they had started a little earlier, that's great. But for you and I and other companies similar to us, hopefully this urgent demand turns into a very long-term relationship, because a lot of those institutions 2 years ago, we never would have got into. They would have been just fine with their indirect business and everything of the same. So again, that's another long-term benefit that we're going to experience from, hopefully.
Yeah, I can't tell. I've had more of those conversations in the last 60 days than I had in the last 4 years, with people saying exactly that. I need X amount, and how quick can you do it? And, we're not going to, same as you, we're not going to make any promises we can't deliver on. And I had a guy say to me, I've had several vendors tell me they can do this, and all of them have failed. And and he said, I said, well, I don't know who those vendors are. All I can tell you is I'm not going to commit more than what I can produce. And we'll come up with a timeline for you. And hopefully we'll produce what we tell you we're going to produce. But let me ask you this. We focus on prime, but you have the ability to fund both prime and subprime. Have you seen a difference? Has the pandemic had any effect more on the subprime or prime, or is it still pretty much business as usual?
I think it's more business as usual. We had friendships, acquaintances within the major subprime institutions across the country. So we focused on getting them live internally very early on in the process. The delinquencies and charges were the big concern going through COVID, right? That was the main thing, is how bad are these portfolios going to turn? Well, my contacts tell me on both ends, they didn't see a drastic change. And so the performance held steady, so they continued to buy more and more business as long as it continued to perform. The subprimes is a great market, and it's something that the CUs should find a way to play into an extent, because a lot of times they want to serve their member base, but they only end up serving the prime member base.
Right.
So we're trying to help them with some interesting products out there to give them some protection from some of that risk. But the subprime business, You just have to churn through so much additional volume of applications. Your approval ratios are low, your funding ratios are slightly lower, your acceptance rate by the consumers are slightly lower. And so it's just a more difficult business. You exhaust a lot more energy trying to tackle that one. But one of the things that we pride ourselves on here is what you said. We can cover the entire credit spectrum from 510, 500, all the way up to 850. We have a lender that could potentially make you an offer.
Sure, sure. You know, in our case, and that's why you and I have a strategic partnership. We didn't want to go into that subprime space.
Mm-hmm.
And, you know, that's really not, even though our two companies, I guess if we looked back, let's say we go back 8 or 9 months, we probably classify our two companies as competitors.
Right.
And maybe we still are in some sense. But, you know, when you and I first started to talk, there were some things that I just didn't want to move into this early. And there were some things that you felt like, you know, maybe there's somebody that can do this more efficiently, or maybe not more efficiently, but it can take some of this off my plate and I can concentrate on what we're really good at. And, you know, so the relationship, you know, between our two companies, we wouldn't be able to do some of the things we're doing today and bringing on some of the clients that we're bringing on today without the strategic partnership that you and I have put together. So hopefully that'll be a long-term relationship. But I hear what you're saying is, you know, these clients that come in and have these large expectations and want it done yesterday, you know, they have to be realistic that it's not a switch that we turn on. And I think most of them, at least from my perspective, most of them have been pretty realistic. And, but let me ask you a question. You know, so we've talked about our traditional business. What about the impact long-term on these online banks? Because, you know, I think in many ways that's being ignored, at least with clients that I talk to. They're not paying a lot of attention to that. What's your thought there? Because I think that's something that really needs to be paid close attention to.
Ignoring them would be a massive mistake for any organization. Now, we're talking a lot about the credit union space. And that's one of the things that the credit unions are going to struggle with is how can they keep up from a technology standpoint with all this new tech that's coming out for the younger generations. You can get on your phone and bank and deposit, and you don't ever have to go by a branch. Why would you change back to the old way that's less convenient? And you talk about branches anymore. Building new branches, it's a thing of the past, in my opinion. You can centralize your location, serve a much wider audience, but unless you can find a way to get in front of the younger generation, 10, 15 years from now, nobody's going to remember you even existed.
Yeah.
And those companies are building a brand and getting stronger every day. But the truth is the lending industry's been stuck in a rut for 80 years? It's doing it the same way it used to do it. It's got to start to evolve at some point. And with AI and the digitalization of e-signatures and being able to apply online and be onboarded online, I think that the credit unions are going to have to make some very uncomfortable, massive investments in technology if they want to continue to play. Otherwise, the great thing for you and I, Craig, is it makes us more valuable because they have the capital, but not the infrastructure to go run out and originate these loans. So as long as they can partner with us, and that was one of the primary goals of Gravity, was let's be the lending arm for credit unions. And if we can get out there and generate that for them, then they can sustain and stay viable for as long as we can.
Yeah, absolutely. You know, I think, listen, the larger credit unions that have, and I kind of think back to my newspaper days, we always dealt with customer churn. Well, these large credit unions have significant churn, of which the dealer produced loans just have slowed, and at one point last year just basically dried up. So I think that's been kind of a, I don't call it a slap in the face, but it's kind of gotten some people awake and said, wait a minute, we need to be thinking about a better way to do business. You know, I've heard more people, you know, my feeling is with our business is have a well-balanced auto loan portfolio. We're not telling people, you know, give up on indirect, but have a balanced portfolio, have a combination of direct and indirect. I bet the financial, the viability of your portfolio, if you take that approach, is going to be much better than what it may have been in past years. And so, I see people starting to think about it, but I don't see a lot of people starting to do anything about it. It's a lot of conversation right now. And I think if you talk about it too long, the opportunity will pass. We've seen that. I mean, I've been in business almost over 40 years. And every time that something was ignored, an opportunity, and most people look at it as an issue, but it's really an opportunity. Every time something was ignored, the newspaper industry did the exact same thing in the 90s. They ignored the internet. And you can see where most newspapers are today. I think the same thing's going on in the credit union space, but at least there's conversations going on. There's movement. I see some new vendors come in that are really making it easy for them to make that transition. I think some of the stuff we're doing, some of the stuff you're doing makes it easier for them to make that transition. And the last thing I'll say about that is the effect it's had on us is, for 15 years, I would say to a bank or a credit union, you've got to drive deposits. So we've got to make whoever's banking at one of your competitors, we've got to get them over and make you the primary financial institution. Drive those deposits. I'm talking to prospects now and saying, checking accounts not the way to go in this marketplace. The best way to secure a new member for a credit union is through a recapture auto loan. Because how many businesses out there come to you and they're really not selling you something, but they're doing something for you. They're saving you money. That's a great way to start a relationship. So, us as a company, we're not pitching much at all checking account acquisition. We're saying grow your member base through auto loans. It's a great way financially. It's a better deal. It's done on a contingency, and you're going to have a long-term relationship. And that's the problem. One thing I see different between my 20 years in newspapers and my 20 years in banking is the newspaper industry did a lot of things wrong, but they paid close attention to customer churn. I don't see banks and credit unions paying a lot of attention to customer churn. They pay a lot of attention to bringing in new customers. They don't do a lot, at least in my experience, and we've dealt with over 1,800 institutions. I don't see a lot being done on the churn side. Maybe this is forcing them to start thinking about that, but we're pitching customer acquisition, member acquisition as an auto loan program now, which I never thought we would do 2 years ago.
Yeah, some of the lenders that we talk with do well at that and some don't. And so when you look at the growth or the attrition of the member base of the credit unions, what they said, the NCUA said it's been a 2 to 4% growth per year for the last several years. But a lot of that comes from the indirect space. And so they are acquiring a loan, but they don't ever truly make them a member. So they slowly bleed off of their books 6-7 years after they fee themselves out. And that's one of the things that they have to do better at is finding a way not just to get the loan or the checking account, but how do we make them active? How do we make them think about us first for any of their financial needs? And I think the small to mid-sized CUs have a hard time with that, which will probably lead to significant consolidation in the CU space over the next decade.
So I know I've promised you 20 or 30 minutes here, but kind of a last thought. What's thinking down the line a little bit? How do you see your business expanding? I mean, ours seems to change not on a daily basis, but I would say on a weekly basis, kind of the concepts that we have and how much more aggressive we need to get with, we want to build out multiple portals to make it easier for our clients to do business with us. And it seems like every time we turn around, there's something more that we want to do. What do you see in the next, say, 12 to 18 months with your business?
With our business, I'm focused on the same things I'm telling the CUs to focus on in technology. We built this company this fast based on hard grinding work with a lot of people that knew what they're doing. So now we need to tie our systems together. We've launched some other personal finance products, financial instruments, and that's one of the things that's been a bit shocking is the CUs are coming to us to acquire just about every loan type you can possibly imagine. And so we're having to be very critical and methodical about choosing the right products where we can generate enough revenue Plus, there's a good flow of leads out there for us to go tap into, and then we can turn them. As far as originating loans, nothing's drastically different from a signature loan to an auto loan until you get to the mortgage side of things where it gets far more complicated. So we want to be able to bring multiple financial instruments to our lending institution simultaneously, so they're more likely to retain those members that we're bringing in the first place.
Okay. I think this is a great time to be in the business. Last year was a tough. I mean, I'd come in here and it'd be one other employee in here, and everybody else was working remotely, and there wasn't a car on my street here in Annapolis. And early on, you're wondering, where is this thing going? But now that we've gotten through this, and hopefully we're towards the end of dealing with the pandemic, I think sky's the limit in terms of business, because it's forced people, including us, it's forced us to think differently. Mm-hmm. And when you think differently, you get creative and good things happen. So, Brian, I appreciate you taking the time. I don't know how much time we've used here, but I promised you 25 or 30 minutes. And I do appreciate the time, appreciate the relationship that our two companies have. And I just wanted to say thanks for spending some time with us.
I appreciate you having me and giving us a platform. It's always fun to talk with you, Craig.
So next on a stellar conversation, we're going to have Roger Powell, who is an M&A expert, been in the business for some 40 years, started with Deutsche Bank. But we're going to have a specific conversation with Roger, who's the managing director of the Burke Group out of Atlanta, on acquisitions, the M&A activity between banks purchasing credit unions and credit unions purchasing banks, which we just saw. One was just a Green State Credit Union in Iowa just yesterday purchased, I think, 2 banks. I didn't see the whole release, but that's a new phenomenon that we're going to have a good conversation with Roger about. Brian, tell everybody where they can get in touch with you and follow your company.
Sure. Just go to gravitylending.com. You can go through any of those portals and get us your information. Our phone numbers are on there, and we'll field all those as quickly as possible. But thanks again, Craig.
No problem. And with us, visit stellarstrategic.com or follow us on LinkedIn. And again, we'll put a notice out on LinkedIn when the next podcast comes with Roger Powell. It's going to be a really interesting conversation about M&A activity and overall disruption in the marketplace. Thanks again, Brian.
All right. Have a great day.